Trading is often misunderstood as a contest of intelligence, access to information, or the ability to act faster than others. On the surface, it appears that those who think more deeply, analyze more data, or react more quickly should naturally outperform. However, beneath this illusion lies a far more critical and damaging issue that quietly undermines performance: uncontrolled decision making driven by assumption rather than structure. This is the hidden cost that many participants fail to recognize until significant damage has already been done. Guessing in trading rarely presents itself in an obvious way. It does not feel like recklessness or randomness in the moment. Instead, it disguises itself as intuition, past experience, or even confidence built from previous wins. A trade executed without a clearly defined edge often feels justified because there is usually some level of analysis supporting it. A chart pattern may look convincing, a news event might seem impactful, or a market move could appear predictable. However, without a repeatable and tested framework, even trades that result in profit hold no real statistical value. They cannot be replicated consistently, and therefore they cannot form the foundation of long-term success. In modern financial markets, especially in the current environment, the consequences of this behavior have become even more severe. Markets are no longer dominated solely by individual participants making discretionary decisions. They are heavily influenced by automation, algorithmic systems, and rapid information processing. These systems operate based on strict rules, consistency, and speed that far exceed human capabilities. As a result, the margin for error has significantly decreased. Random or assumption-based decisions simply cannot compete with structured approaches that are executed with precision and discipline. The environment punishes inconsistency more aggressively than ever before. The cost of guessing extends far beyond immediate financial losses. While losing money is the most visible outcome, the deeper impact lies in the inability to measure performance accurately. When decisions are made without a consistent framework, results become inconsistent and unreliable. A winning trade does not necessarily indicate a good decision, and a losing trade does not necessarily indicate a bad one. Without clarity, it becomes impossible to distinguish between skill and luck. This lack of measurable feedback prevents meaningful improvement, as there is no clear way to identify what is working and what is not. Over time, this creates a cycle where mistakes are repeated, adjustments are made randomly, and overall performance stagnates or declines. Another critical consequence of assumption-driven trading is emotional instability. Trades that are not grounded in a defined process often carry a higher degree of uncertainty. This uncertainty intensifies emotional reactions during both losses and gains. During drawdowns, fear becomes more pronounced because there is no structured reasoning to rely on. Doubt begins to creep in, leading to hesitation or impulsive changes in strategy. On the other hand, when trades move in a favorable direction, greed can quickly take over. Without predefined rules, there is a tendency to hold positions longer than planned or increase risk unnecessarily. This emotional volatility gradually erodes discipline, making it increasingly difficult to maintain consistency in decision-making. As this pattern continues, the overall quality of decisions deteriorates. Confidence becomes unstable, swinging between overconfidence after wins and self-doubt after losses. This inconsistency affects not only trading performance, but also the ability to think clearly under pressure. Decisions become reactive rather than intentional, and the original goal of achieving consistency becomes further out of reach. The trader becomes trapped in a cycle where each outcome influences the next decision in an unpredictable way, reinforcing the very problem that needs to be solved. Breaking free from this cycle requires a fundamental shift in perspective. The first step is acknowledging that randomness and assumption have no place in a professional trading process. Every action must be deliberate, based on predefined conditions that are clearly understood and consistently applied. This does not mean eliminating uncertainty, as uncertainty is an inherent part of markets. Instead, it means managing uncertainty through structure rather than reacting to it emotionally. A structured approach focuses on defining specific criteria for entering, managing, and exiting trades. These criteria must be based on logic, tested over time, and applied without deviation. The goal is not to predict what the market will do next, but to create an environment where decisions are made consistently regardless of short, term outcomes. By doing so, results become measurable, allowing for continuous improvement based on actual data rather than perception. Ultimately, the transition from guessing to structured decision making is what separates inconsistent participants from those who achieve long-term stability. It shifts the focus from chasing outcomes to managing processes. When decisions are grounded in predefined conditions, emotional interference is reduced, performance becomes more consistent, and the ability to adapt improves significantly. The professional mindset is built on one core principle. Every decision must be intentional, repeatable, and aligned with a defined framework, ensuring that success is driven by process rather than chance. A professional trading approach is not built on instinct, excitement, or constant market watching. It is built on structure, clear, defined, and repeatable structure that removes uncertainty from the decision-making process. This structure takes the form of a rule-based framework where every action is guided by predefined conditions rather than momentary judgment. Without rules, consistency is impossible. With rules, performance becomes something that can be measured, analyzed, and improved over time. The foundation of any rule-based framework begins with defining the trading environment. This step is often overlooked, yet it plays a critical role in reducing unnecessary risk and confusion. Not every market condition is suitable for every strategy, and not every time frame aligns with every trading style. A structured approach requires clarity on what markets will be traded, which time frames will be used, and under what specific conditions participation is allowed. By narrowing focus, unnecessary exposure is reduced, and impulsive trades that fall outside the system are eliminated. This alone significantly improves discipline and decision quality. Once the environment is clearly defined, the next step is identifying and developing an edge. An edge is often misunderstood as the ability to predict market direction, but in reality, it is a statistical advantage that plays out over a series of trades. It does not guarantee success on any single trade, but it increases the probability of favorable outcomes over time. This edge can be based on various factors such as price behavior, recurring patterns, volatility conditions, or market structure. What matters most is not the complexity of the edge, but its ability to be tested, verified, and consistently applied. If an edge cannot be measured, it cannot be trusted. With an edge in place, entry rules must be defined with precision. A valid trade entry is not based on a feeling or partial confirmation. It is triggered only when all predefined conditions are fully met. This eliminates subjective interpretation, which is one of the primary causes of inconsistency in trading. When entries are clearly defined, every trade taken follows the same logic, regardless of market noise or emotional influence. This creates uniformity in execution, making it easier to evaluate performance objectively. Risk management is the core of any sustainable trading framework. Without it, even the strongest edge can fail. Every trade must have a predefined level of risk that is determined before the trade is executed. This includes position sizing, stop, loss placement, and the maximum acceptable drawdown over a series of trades. Risk is not something that changes based on confidence, recent performance, or external opinions. It is fixed and consistent, ensuring that no single trade can cause significant damage to overall capital. This approach shifts the focus from trying to win every trade to protecting capital over the long term. Equally important to entries and risk management are exit rules. Many traders focus heavily on finding the perfect entry, but neglect to define how and when to exit a trade. This often leads to profits being reduced due to hesitation or greed, while losses expand because of indecision. A rule-based framework removes this uncertainty by establishing clear exit conditions. These include predefined profit targets as well as rules for early exit if the original trade setup becomes invalid. By doing this, decisions are no longer influenced by emotions during the trade, but are instead executed according to plan. Another essential component of a structured framework is documentation. Every trade must be recorded in detail, including the reasoning behind the trade, the conditions that were met, the outcome, and whether the trade followed the established rules. This process creates a feedback loop that is critical for growth. Without documentation, mistakes are easily forgotten and successes are often misunderstood. With proper records, patterns begin to emerge, allowing for informed adjustments and continuous improvement. Over time, This transforms trading from a random activity into a data-driven process. It is important to understand that a rule-based system does not eliminate losses. Losses are an unavoidable part of trading, regardless of skill or experience. However, what a structured framework does provide is control and consistency. Losses become planned, limited, and manageable rather than unexpected and destructive. This consistency allows performance to stabilize over time, reducing emotional stress and improving decision-making clarity. As consistency improves, confidence also becomes more stable. Instead of fluctuating based on recent outcomes, confidence is built on trust in the process. This shift is critical because it allows traders to remain disciplined even during periods of drawdown. When every decision is backed by a defined framework, there is less room for doubt and second-guessing. In the long run, the true value of a rule-based trading framework lies in its ability to create sustainability. It transforms trading from a reactive activity into a structured process where outcomes are influenced by discipline rather than chance. By focusing on rules instead of results, the foundation for long-term performance is established. Every trade becomes part of a larger system, and every outcome contributes to a clearer understanding of what works and what does not. This is what separates inconsistent efforts from a professional approach built on structure, control, and continuous improvement. Emotions are often blamed as the primary reason for failure in trading, but this perspective is incomplete. Emotions themselves are not the problem. They are natural human responses to uncertainty, risk, and potential reward. Fear, greed, and impatience are built into human behavior and cannot be eliminated. The real issue arises when these emotions are allowed to influence decisions in an uncontrolled manner. When reactions override structure, the integrity of the trading system begins to break down, leading to inconsistency and avoidable mistakes. Emotional interference typically does not appear in obvious or dramatic ways. It often begins subtly through small deviations from established rules. A trade might be entered slightly earlier than planned due to the fear of missing out on an opportunity. Another trade might be closed prematurely because of discomfort with temporary drawdown. In some cases, a position may be held longer than intended in the hope of gaining more profit. These actions are rarely deliberate acts of recklessness. Instead, they occur when the decision-making process is not fully anchored in a structured framework. Without a strong foundation, emotions naturally fill the gap. One of the most effective ways to reduce emotional influence is by implementing predefined decision points. This means that every possible scenario, entry, exit, risk, and trade management is planned in advance. When decisions are made before the trade is executed, there is significantly less pressure to think in real time. Real-time decision-making is where emotions tend to have the strongest impact, as uncertainty is highest in the moment. By shifting critical decisions to a pre-trade phase, the role of emotion is minimized and execution becomes more mechanical and consistent. Risk exposure is another major factor that directly affects emotional stability. When too much capital is placed at risk on a single trade, emotional intensity increases dramatically. Even a well-structured system becomes difficult to follow under these conditions because the potential loss feels too significant. This leads to hesitation, second-guessing, or impulsive actions that deviate from the plan. On the other hand, when risk is controlled and kept within predefined limits, emotional pressure is reduced. This allows decisions to be executed more calmly and rationally. Proper risk management is not only a financial safeguard, but also a psychological one. Routine plays a critical role in maintaining emotional discipline. A consistent daily process creates a sense of stability, which reduces uncertainty and improves focus. This routine should include structured market preparation, where key levels, conditions, and scenarios are identified before any trades are considered. It should also include a clear execution phase, where trades are taken strictly according to predefined rules, and a post-trade review process, where performance is analyzed objectively. By repeating this routine consistently, behavior becomes more predictable, and the influence of emotions is gradually reduced. Another essential component in eliminating emotional interference is self-awareness. Without awareness, emotional patterns go unnoticed and continue to affect decisions in subtle ways. By paying attention to behavior over time, recurring patterns begin to emerge. For example, consistently exiting trades too early may indicate an underlying fear of loss. Taking too many trades in a short period may suggest impatience or a need for action. Increasing position size after a series of wins may reflect overconfidence. Identifying these patterns is the first step toward correcting them. Once recognized, specific adjustments can be made to reinforce discipline and maintain alignment with the trading system. It is also important to understand that emotional control does not mean suppressing or ignoring emotions. Attempting to completely eliminate emotions is unrealistic and often counterproductive. Instead, the objective is to create a system where emotions have minimal influence on decision-making. This is achieved by strengthening the structure around the process rather than trying to change human nature. When rules are clear, risk is controlled, and routines are consistent, emotions naturally become less disruptive. Over time, this structured approach leads to greater confidence and stability. Confidence is no longer based on the outcome of individual trades, but on trust in the process itself. This shift is significant because it reduces the emotional impact of both wins and losses. A winning trade does not lead to overconfidence, and a losing trade does not create unnecessary doubt. Each outcome is simply part of a larger series governed by probabilities and consistency. As emotional interference decreases, decision quality improves. Trades are executed according to plan, risk is managed effectively, and performance becomes more consistent. This does not guarantee immediate success, but it creates the conditions necessary for long-term improvement. The focus shifts away from reacting to market movements and toward following a structured process with discipline. Ultimately, eliminating emotional interference is not about becoming emotionless, it is about becoming process-driven. A professional approach ensures that every action is guided by predefined rules rather than momentary reactions. By doing so, the trading process becomes more stable, more measurable, and far more sustainable over time. Consistency in trading is often misunderstood as the ability to produce winning trades on a regular basis. In reality, consistency has very little to do with individual outcomes and everything to do with behavior. It is not built on profits, but on the repeated execution of a structured process. Profits and losses are simply byproducts of that process. When the focus shifts away from outcomes and toward execution, trading becomes more stable, measurable, and sustainable over time. A consistent process always begins with preparation. This stage sets the foundation for everything that follows. Preparation involves analyzing the current market environment, identifying potential setups, and clearly defining the conditions under which trades will be considered. It is during this phase that uncertainty is reduced and clarity is established. Without preparation, decisions are made reactively, often under pressure and influenced by emotion. With proper preparation, execution becomes more straightforward because the key variables have already been considered in advance. Preparation also creates a sense of control. Markets are inherently uncertain, and no amount of analysis can eliminate that uncertainty. However, by defining what to look for and what to avoid, the decision-making process becomes more focused. This prevents overexposure to random market movements and reduces the likelihood of impulsive trades. In essence, preparation transforms trading from a reactive activity into a proactive one. Once preparation is complete, the next phase is execution. This is where discipline plays a critical role. A trade should only be taken if it meets all predefined criteria established during the planning stage. There is no room for partial confirmations or subjective adjustments. Consistency in execution means applying the same standards to every trade, regardless of recent performance or external influences. A losing streak does not justify breaking the rules in an attempt to recover losses, and a winning streak does not provide permission to take on additional risk. Every decision must remain aligned with the established framework. Discipline during execution is often tested in moments of uncertainty or emotional pressure. This is why a well-defined process is essential. When rules are clear and specific, there is less need for interpretation in real time. Decisions become more mechanical, reducing the influence of fear, greed, or impatience. Over time, this disciplined approach builds confidence, not because of short-term results, but because of trust in the process itself. After execution, the process continues with post-trade analysis. This step is frequently neglected. yet it is one of the most valuable components of long-term improvement. Every trade, regardless of its outcome, must be reviewed to assess whether it was executed according to the rules. The focus here is not on profit or loss, but on the quality of the decision-making process. This distinction is critical. A trade that results in a loss can still be considered successful if it followed all predefined rules. Conversely, a profitable trade that violated the system is a sign of poor discipline and should not be reinforced. By consistently reviewing trades in this manner, a clear picture of performance begins to emerge. This leads to the next important element: tracking results over a series of trades. Individual outcomes in trading are largely influenced by randomness. One trade alone provides very little meaningful information. However, when multiple trades are analyzed together, patterns begin to form. These patterns reveal strengths and weaknesses in both the trading system and the execution process. For example, recurring losses in specific conditions may indicate a flaw in the strategy, while repeated rule violations may highlight behavioral issues that need to be addressed. This data-driven approach allows for informed decision-making when it comes to improving the system. Adaptation is a necessary part of growth, but it must be approached with caution. Making changes based on short-term results or emotional reactions can introduce new inconsistencies and undermine the entire framework. Instead, adjustments should be based on sufficient data collected over time. This ensures that any modifications are grounded in evidence rather than perception. Controlled adaptation also reinforces discipline. It prevents the tendency to constantly change strategies in response to temporary setbacks. By committing to a structured evaluation process, improvements become gradual and intentional rather than reactive. This stability is essential for maintaining consistency, as frequent changes disrupt the ability to measure performance accurately. Patience is another key factor in developing consistency. Results in trading are not immediate, and expecting quick success often leads to frustration and poor decision-making. A structured process requires time to produce meaningful outcomes. During this period, it is important to remain focused on execution rather than results. Trust in the process must be maintained even when short-term performance is not ideal. Over time, disciplined execution begins to produce more stable and predictable results. This does not mean that losses disappear, but rather that they become controlled and expected within the framework of the system. As consistency improves, emotional pressure decreases, and decision-making becomes more confident and objective. Ultimately, consistency in trading is the result of commitment to a well-defined process. It is built through preparation, reinforced through disciplined execution, refined through analysis, and strengthened through patience. By focusing on behavior rather than outcomes, trading evolves from a random activity into a structured and professional practice. This shift is what creates the foundation for long-term stability and continuous improvement. The final stage in developing a sustainable trading approach is the transition to a professional mindset. This shift is not about learning new strategies or discovering hidden indicators. It is about changing the way decisions are viewed and executed. At its core, this transition requires moving away from outcome-based thinking and fully embracing process-based thinking. This distinction is critical because it determines whether trading remains inconsistent and emotionally driven or becomes structured and reliable over time. A professional mindset begins with understanding that individual trades hold very little significance on their own. Each trade is simply one event within a much larger series of outcomes. When viewed in isolation, a single win can create overconfidence, and a single loss can create doubt or frustration. However, when trades are seen as part of a broader sequence, their emotional impact is reduced. This perspective allows for more stable decision-making as the focus shifts from short-term results to long-term consistency. The goal is no longer to win on every trade, but to execute each trade correctly according to the system. This approach naturally leads to a stronger sense of accountability. In a professional framework, every outcome is evaluated based on adherence to predefined rules rather than external factors. Market conditions, volatility, and unexpected events are always present, but they are not used as excuses for poor execution. Instead, responsibility is placed entirely on the decision-making process. If a trade follows all the rules and results in a loss, it is still considered a successful execution. If a trade breaks the rules and results in a profit, it is treated as a failure in discipline. This level of accountability creates a foundation for continuous improvement, as it encourages honest evaluation and eliminates the tendency to justify mistakes. Patience becomes one of the most valuable assets within this mindset. Inexperienced participants often feel the need to be constantly active, believing that more trades will lead to more opportunities. In reality, unnecessary activity increases exposure to risk and reduces overall performance. A professional approach is highly selective. Trades are only taken when all conditions align with the system, and anything outside those conditions is ignored. This selectivity reduces noise, limits emotional involvement, and ensures that each trade has a clear purpose. Over time, patience shifts from being a challenge to becoming a strategic advantage. Discipline is the element that holds everything together. Without discipline, even the most well-designed system will fail. A professional mindset treats rules as non-negotiable. There are no exceptions based on intuition, recent performance, or external opinions. Every rule exists for a reason, and breaking those rules introduces inconsistency into the process. Discipline ensures that the system is applied the same way in all conditions, which is essential for producing reliable results. It also reinforces trust in the process, as consistent execution leads to more predictable performance over time. In the current trading environment, the importance of this mindset has become even more pronounced. Markets are increasingly driven by automation, algorithmic systems, and rapid information flow. These conditions demand a higher level of precision and consistency than ever before. Random decision making and guesswork cannot compete in such an environment. Success is no longer determined by isolated moments of insight, but by the ability to operate within a structured framework and execute it with accuracy. Adaptability is still important, but it must be grounded in data and controlled adjustments rather than emotional reactions. The transition to a professional mindset does not happen instantly. It is a gradual process that requires commitment and self-awareness. Old habits, especially those driven by emotion or impulsive thinking, take time to replace. Progress comes through consistent effort, regular evaluation, and a willingness to refine the process when necessary. There will be challenges along the way, including periods of doubt and frustration, but these are part of the development process. The key is to remain focused on execution rather than outcomes. As this mindset becomes more established, trading begins to feel less chaotic and more controlled. Decisions are made with clarity, emotions have less influence, and performance becomes more stable. Confidence is no longer dependent on recent results but is built on trust in the system and the ability to follow it consistently. This shift is what ultimately separates structured trading from random participation. The path toward professionalism can be summarized in a clear and practical way. First, eliminate guesswork by ensuring that every decision is based on predefined rules. Second, build a structured framework that defines how trades are identified, executed, and managed. Third, control emotional influence by relying on preparation and risk management rather than reaction. Fourth, commit to a consistent process that includes preparation, execution, and review. Finally, adopt a mindset that prioritizes discipline, patience, and accountability above all else. This transformation begins with a single, deliberate decision to stop guessing and start executing with intention. From that point forward, every step taken within a structured framework moves closer to long-term consistency and professional-level performance.